So you've probably heard of digital dollars, or stablecoins. They're a huge part of the online economy. And the whole idea is that they give you the stability of a real dollar, but with the speed of the internet. But what's actually backing that up? Who's making sure they're safe to use? Well, the US government has a brand new answer, and we're going to break down exactly what it means.
All right, let's start right with the official definition from the law itself. A payment stablecoin is a digital asset where the company that makes it gives you a crucial promise. You can always trade it back for a fixed amount of real money. The best way to think about it is like a casino chip. It's a digital token that's supposed to be worth exactly $1 every single time you go to cash it in.
And that's the billion-dollar question, isn't it? Literally, that word promise is everything. I mean, if anyone can just make that promise, how do you really trust that your digital dollar is backed by a real one? This is where things can go wrong, and it's the exact problem this new law is trying to fix.
So, in this explainer, we're going to walk through how the US is planning to tackle all of this. We'll start with the new law itself, then dive into the new rules of the game. After that, we'll look at the interesting regulatory system it sets up, and finally, we'll talk about what this all could mean for the future of digital money.
Okay, so here it is, the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or, the much easier to say, Genius Act. What makes this such a big deal is that it's really the first serious attempt in the United States to build a single, national set of rules just for this new kind of digital money.
And just look at how fast this all happened. From being introduced in the Senate to becoming law in just over 2.5 months. That's lightning fast for Washington. It just goes to show you how urgently everyone felt the need to get some clear rules on the books for the stablecoin market.
The heart of this entire law really boils down to this one simple rule. The Wild West days are over. If you want to issue a payment stablecoin in the US, you now have to be a permitted payment stablecoin issuer. Plain and simple, you need a license to operate.
So what does it actually take to get permitted? The law is super specific about who can issue these coins and exactly how they have to run their business. So let's get into those new rules of play.
The Act basically sets up two main paths to get a license. You can become a federal qualified issuer, and you'll be supervised by a federal banking regulator, the OCC. Or you can be a state qualified issuer and be regulated at the state level. This kind of dual system is pretty classic in American finance. It's all about balancing federal oversight with letting states innovate.
And getting that license is no joke. It's not just filling out a form. Applicants are put under a microscope. Regulators are going to look at everything: your company's financial health, the integrity of your leadership, your policies for letting people cash out. They have 120 days to decide, and the big test is whether your operation could be considered unsafe or unsound.
Now we're getting to the absolute core of this law, the reserve requirement. This is the bedrock of the whole thing. For every single digital dollar you create, you have to hold $1 worth of safe, high-quality assets in the bank. No wiggle room. This is how the law makes sure that the promise is actually real.
And the law gets very, very specific about what counts as a high-quality reserve. We're talking about actual cash, deposits in a bank, and super short-term U.S. government debt. You see the theme here, right? It's all about safety and liquidity. These are all things that can be turned into cash pretty much instantly to pay back customers if they need it.
Then, the law adds another really important layer of safety. It bans something called rehypothecation. It's a fancy word, but what it means is that issuers can't play games with your money. They can't lend out the reserves or use them to make their own risky investments. A reserve dollar has to stay a reserve dollar, full stop.
So a compliant company's reserves might look a little something like this. A mix of ultra-safe stuff, maybe a big chunk in treasury bills, some cash sitting in the bank for quick excess, and some overnight loans backed by government debt. Now look at what's not on this chart. Risky corporate bonds, commercial paper, or other crypto assets. It's all about keeping risk as low as humanly possible.
And the rules don't stop with the reserves. Issuers have to be way more transparent. They have to publish monthly reports on their reserves and get them audited. They also need to have solid systems for managing risk. And this is a big one. They have to follow the same anti-money laundering laws as regular banks.
Okay, let's zoom in on one of the most interesting parts of this law, this dual regulatory system. Because this isn't just the federal government laying down the law from on high. It's actually designed to be more of a partnership between Washington, D.C. and the states.
So what the law does is it basically keeps the states as these laboratories of innovation.
States can set up and run their own regulatory programs for stablecoin companies just as long as their rules are substantially similar to the federal ones. This lets them tailor their approach, which is especially helpful for smaller, up-and-coming companies.
But that freedom for the states comes with a very specific line in the sand, a tripwire, if you will, and it's set at $10 billion.
The second a state-licensed issuer's stablecoin crosses that $10 billion mark, they are suddenly considered big enough to matter to the whole financial system. And that automatically triggers an extra layer of federal oversight. It's a safety valve. The bigger you get, the more regulators are watching you.
All right, so let's pull all these threads together. What does the Genius Act really mean for the future of digital money, both here in the US and maybe even around the world?
At its heart, this law is a balancing act. The point isn't to kill innovation. It's to give it a legitimate, safe foundation to build on. It's all about moving digital dollars out of this regulatory gray area and into the mainstream financial world, where everyday people and the economy as a whole are protected. So let's just quickly recap the big takeaways. First, the Genius Act creates the first ever national rulebook for stablecoins. It requires strict one-to-one reserves and tons of reporting. It creates that dual system balancing federal and state power. It's designed to stop collapses and fight financial crime. And this is huge for the industry. It makes it clear that these stablecoins are not securities, which ends a massive amount of uncertainty.
And that really leaves us with the big question for the future. By providing all this clarity and safety, has the U.S. just laid the groundwork to become the #1 spot in the world for trusted digital dollars? Or will these rules end up being too much of a hurdle, pushing all this innovation somewhere else? That right there is the multi-trillion-dollar question for the future of finance.